Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Okay, welcome everyone to a very special edition of Sparta Market Outlook. It is our Christmas edition, and to shake things up a bit, we are not going to be focusing so much on the prompt market, but we're now going to have a discussion about the 2025 outlook. And yes, we're going to make predictions in terms of different market trading opportunities. Flat price, of course, that's the obvious one. East-west, spreads, cracks, margins. We're going to go through all of those and give our bull case, bear case, and ultimately our 2 cents worth of what we think should be happening in 2025. And please feel free to let us know when we were wrong and when we were right. And hopefully we're more right than wrong. But ultimately, this is the whole point of starting a new year, having a clear view of what we want or what we think the market is going to do. And then we'll course correct as the events come about during the year. Today, I'm joined with Neil. Hi, Neil. How are you?
Very good, thanks.
We also have June from Singapore. Hi, June. How are you today?
Hi, everyone. I'm good. Thank you.
And of course, Jorge from Madrid. How are you, Jorge?
Hi, Felipe, and hi, everyone. Very good here.
Excellent. So we're going to ask a series of questions and look at the answers between ourselves, have a little bit of a debate. And obviously, we couldn't start without looking at flat price. So maybe let's start with that one. Let's look at the bull case and the bear case before we come up to a conclusion on Brent flat price next year. What do you think is going to happen? Who wants to start?
I'll go. So I guess maybe we should not even talk about average Brent flat price, right? What good does that do anybody? Is that a fair question to start to sort of question back at you? Obviously, you have to trade this as things happen, but it's just like a vehicle for discussing the problems, right?
Exactly. I mean, ultimately, the number itself is probably the least important one. It's much more around how do we get to that number? It's what is the bull case? What is the bear case? And let's have a little bit of a debate about, based on those cases that we're outlining, what do we think should ultimately happen?
Yeah. So I can start us off, and I guess it's an amalgamation of all the stuff that we've been talking about over the last 4 weeks, right? Because we've talked about many of these elements. I will try and be very brief. I think I'm getting more bullish. No, I'm definitely getting more bullish. And there's a few things happening, right? So the first is sanctions, right? So I think the sanctions risk is much higher than it has been for a number of years. And it's not just sanctions risk in a very straightforward sense. I just think there's more risk that some barrels are taken off the market, right? Be it Iranian, be it Russian. And you can see the West wants to sanction more. There's more vessels being added to the sanctions list this week. And of course, all that could change when Trump comes in. But, Trump could sort of broker a deal with Russia, but he could at the same time take Iranian barrels off the market. I think June, right, from what we've observed in the last few weeks, it does look like China's starting to be more serious about taking less Iranian. Is that a fair thing to say?
Yeah, I think we've seen flows reducing on the Iranian side into China.
I think in either last week or 2 weeks ago, this was something that we were seeing, but we needed to have a little bit more validation in terms, was it a blip or was it a new trend? Can you guys comment on that?
We predicted that WAF barrels and Angolan particularly will pick up, and it has as well. The activity on the Angolan barrels has picked up significantly compared to the previous month of trade. And also the PG market has been very active as well from China.
Okay.
Yeah, we're still right at the start of the February cycle, right? We're getting the Al Shaheen tenders back soon, basically. So exactly say, but if you look at things like the EFS just now, and we're going to talk about the EFS in a minute, but the Dubai market is looking a lot stronger than the Brent market recently, and we're now sub $1 barrel EFS. So something is happening, relatively speaking, in the East that's keeping Dubai bid up, right? More so than over the last 9 months or so. So something's shifting, let's say. And then the sort of second thing on the docket is OPEC decisions, right? And I know that we sort of, particularly I packaged this in a very bearish way over the last few months, but I'm allowed to change my mind too. And I think it starts to get, eventually they make this thing tight. And I'm sort of harking back to, do you remember last week we talked about the EIA steel? That's their forecast. And they are suddenly projecting draws in 2025. And I had a bit of a dig around just to try and figure out what the difference is between the steel, which is the EIA, and what the IEA are saying. And the IEA still has a 1 million barrel per day long balance, even with no OPEC barrels coming back, whereas the EIA are bringing back some OPEC barrels, but they're now short. And I'm trying to look into the differences. And one of the things that strikes me is that the IEA are projecting massive supply growth from non-OPEC, right? Something like 2 million barrels a day, which for me is just very, very big. And I think that there's downside risk to that. And you can see it in things like Brazilian supply over the last few months has been very disappointing. And I think the IEA might be proven to be a bit optimistic on that side of things, right? And also, if you look at the stock draw, it's always like, okay, there's a balanced forecast, but what happened in the last few months? And over the last few months, or let's say over 2024 on average, OECD onshore stocks are flat to drawing. And there's been, yeah, I mean, things just look tight. The US commercial stocks look tight. Cushing is very low. And then we're sort of thinking about another draw next year, partly on OPEC, partly on low non-OPEC supply, or lower than the IEA see it. So I kind of think that points to the market just being tight. So I'm sort of looking at that as a
So let
as
me
more
let me
bullish than I was
let me
before.
unpack that, because I everything I've read so far in other people commenting on next year, except obviously the perma bulls that we all know, but there's been a lot of bearish talk, and we'll go into that. We obviously need to defend the downside case, but let's unpack what you're saying with regards to OPEC and then non-OPEC separately. Okay, so on the OPEC side, what makes you, a bit more bullish in this case?
I just think their level of coherence is better than we all think, right? So it's a fairly successful meeting. They're again delaying quite substantially, bringing any barrels back. You get the feeling that if they feel the need to, they'll just keep delaying at the moment. I mean, I always thought, oh, okay, there's going to be a price war, but I just don't see that happening just now. We talked about that recently as well. Maybe they just can't afford it. And they're in a kind of nice position where they might expect, let's say, for example, non-OPEC supply to disappoint. They might expect some Iranian barrels to come off the market. So they're basically positioned themselves really nicely. If there's any kind of disappointment on supply from the rest of the world, they're the ones back in control. And I guess I just think OPEC are now the balancing element to all this, but they're always going to lag price, right? Because they want it to. They want price to be high. So I guess, does that make sense to you guys?
No. I mean, obviously it makes sense. Now it's a question of whether they can make it happen or not, or do we believe them? But the case here you're making is that they have their act together and they're actually knowing what they're doing, and we're maybe underestimating them.
Yeah, I think that's fair. And then there's the other thing, which is the open secret, right? And then we can sort of move on, I guess, because the open secret that they're actually producing more than they say. And if that's true, then probably their spare capacity is lower than we all think. And that means if Iranian barrels do come off in any big way, the market might actually wake up and think, oh, okay, actually, there's not so much spare supply as we thought now. And that might produce some kind of reaction as well.
Okay. And what about non-OPEC? Because there's, as you were mentioning before, on the other side of the coin is that it seems like the non-OPEC supply is going to be abundant, but you're maybe suggesting that this is a bit exaggerated, or maybe not as much as people anticipate. Is that what you're saying?
Well, there's a bit of a disparity, right? So the EIA are saying one thing, I think it's 1 million barrels a day next year, and the IEA are saying close to 2, as far as I can tell. And 2 strikes me as a very big number generally. And there's also a sort of baseline games being played here. So the EIA have a a bigger number this year, and the IEA have a smaller number this year, right? So there's always some kind of baseline games going on. I'm just looking at things like Brazilian supply, not particularly healthy at the moment. Most people have a sort of reasonably conservative forecast for the US going forward. I fully admit that, I'm not fully into the details of what supply growth needs to look like or will look like next year, but I can just comment that 2 million barrels a day of non-OPEC seems quite big from the IEA, and I think that a lot of people might see that as a bit too optimistic.
Okay. So we talked about the sanctions. That's a potential, and again, we may have Russia back, but against Iran. So there's, but there's a debate around sanctions, and it's clearly not going to be on day one. It's on the, obviously Trump claims that on day one, but it's an exaggeration. But obviously there is a willingness to sort out the Russian situation. But again, in the meantime, you're going to have issues with Iran. We're already seeing it with China buying less Iranian barrels. So that's a reality. We have OPEC and non-OPEC supply. But we also have on the demand side, China with this, a potential stimulus package. What do you guys think about that?
I'll go. So I think maybe the main thing in the short term is the fact that China looks like it's coming back to the legitimate market versus the non-legitimate market. I think that's the first thing to say. And then the second thing to say is they are very serious about stimulus, right? So we've had a very weak year this year in terms of crude imports and crude runs. They are getting really serious about stimulus. I'm not saying I know which way it's going to go, but eventually it will make some kind of dent on basically their economic activity, and maybe just running more crude becomes part of that drive to inflate the GDP numbers, for example. Is that a fair thing to say, guys?
June, what do you think?
Yeah, I think China's in the spotlight, and seems like the government is quite serious about stimulus, so it should translate to some higher crude buying. And if flat price is low enough, the SPR barrels will also be filled in China. So yeah, I agree with the higher demand picture from China there.
And what about, macro in general? We are now having let's say a Trump bonanza on the stock markets. When you look at the debt market, there is actually some concern about inflation coming back again, at least in the US, which is surprising because now today actually we're expecting the Fed to bring down rates again, 25 basis points. But the smart money in Wall Street is sort of betting that with all of this investment bonanza that you will have in the US, that inevitably will lead to higher inflation. That obviously is negative in terms of higher interest rates. It is negative and positive because there is a sort of like an investment bonanza going on, which would lead to higher consumption, etc. But at the same time, it would also lead to higher inflation. What is your take on the macro situation, particularly in the US? Because unfortunately, Europe is becoming more and more irrelevant. But that's for another podcast, a more depressing one. But okay.
Well, there's two things to that. There's already concern about inflation, basically, in the last few months. I think it's fair to say that it seems less like the inflation battle has been won, which you could have probably stated a few months back. And so there's already an issue seemingly emerging on the inflation side. But I guess we're obviously not macro experts. I guess I would bring this back to what can you expect on oil demand? In the OECD, I would tend to state that there's very limited upside to oil demand in either case. I'm almost tempted to say that, you probably got some kick to oil demand this year because cracks were much lower year on year. So it's sort of flat price or retail prices for gasoline and diesel were much lower over the last few months. I think you probably even saw elements of that in Europe in terms of forward heating oil demand. There's lots of stories about consumers in September, October, and you see it in some of the data as well. But that, fizzles out necessarily, right? It's the short-term thing. I think that the upside to OECD oil demand is very limited. It's basically a structural decline, except in sort of places where you're switching from diesel to gasoline. You might have had a bit of a boost this year from prices. So I wouldn't be bullish on OECD oil demand next year.
Okay, so that's probably part of the downside case. So let's move on to the downside case or the bearish case. What arguments do you guys have there to justify a lower flat price next year?
I think they're all basically just the opposite scenarios, but I think they're less compelling. So let's say OPEC compliance falters. I don't really think that's going to happen. I mean, they're just trying to improve compliance now slightly, and it's sort of working. And I just don't see a reason why, at the moment, why things would suddenly break down when they've positioned themselves kind of nicely for next year, in case something happens in Iran, as we've just said. We could say that sort of sanctions don't do much, in which case you don't get really any impact on Iran or Russian barrels. Again, I think the risk is now skewed to the other way. And then it's just things like global demand disappointments. So maybe end user demand really comes in much lower than we suspect because there's a real trade war instead of just a threat to the trade war. And then maybe Chinese stimulus completely disappoints and Chinese buying gets even worse. So that's the sort of downside case. I think it's less compelling, let's say. As usual with all these things, you basically have to trade what's happening. And that's why I sort of bring us back to oil stocks in the OECD have not been building at all this year. In fact, they've been a small draw. So I just think the downside case is less compelling. Let's just say, let's just leave it there.
No, I mean, as I said, it's when I read your notes, guys, before the pod, I was actually quite shocked because everything I read so far presents a very bearish picture for next year. I even saw a report from someone, a hedge fund, that was basically saying that the supply surplus that for next year is probably one of the highest he's seen in many years, and he's sort of anticipating oil at 40 and things like that. Now, the fact that you said, for example, that the OECD oil stocks are actually flat this year in an environment where everyone was expecting them to grow is a telling story. With OPEC now being much more conscious about compliance and things like that, those arguments are absolutely valid. And maybe the point here is just say, hey guys, don't just fall into the trap of being like the herd mentality of everything's bearish and all that, and just raising the topics here of there is a potential bull case. And the fact of the matter is that you, Neil, you seem to be quite bullish about it, and you're quite convinced about it. And I think it's a healthy conversation to be had, especially in an environment where it seems, at least with everyone I talk to, that there is a sort of like a very bearish sentiment for next year.
Yeah, I don't think I'm quite super convinced. I'm
No.
obviously going to be wrong because I've just said it, but no, I tend to agree. And part of the thing is that there, as you said, there's this herd mentality, and when you have some of these agencies putting out like 1 million barrels a day long 2025 balance for like
Exactly.
9 months in a row, it tends to sort of seep in, and it's almost worth saying to yourself, actually, I'm not going to read these reports in case I learn something I shouldn't, or I don't want to learn that in the end.
But that's exactly the point. When you take at face value these reports where they're showcasing 1.8 or 2 million barrels, extra, that is when you take it at face value, then of course you need to think about a $40 barrel Brent, But is that really going to happen? And here we have conflicting messages from the two agencies that you mentioned before. I would try to spell them out, but I would probably get confused with the EIA and whatever. But yeah. Anyway, by the way, if you get it wrong all the time, then you can become famous and you can have an index like the reverse Kramer index like you have on stocks, So keep going. Maybe if you're always wrong, then you will always be right at the same time. So
I have actually heard someone say that in a prior role about like not about me specifically, but
no such thing as bad publicity. If you can become famous for being always wrong, then hey, you're going to make millions anyway.
very
Let's move
reliable,
on.
yeah.
Let's move on. So, I mean, we can, let's not, this is not about giving an absolute number. It can be, 80, 90, 100, that's God knows. Then it's just momentum, sentiment, things like that, and wars or but we don't know. I would just summarize by saying there's a bull case here, and from the evidence that you have been gathering, and those little details like OECD not building stocks, like Brazil not actually supplying as much as everyone said they would, those are details that actually matter and that we will need to think about. Let's move on because we have a lot of things to discuss. East-West, that's the other potential trade for next year on Brent, on diesel, on gasoline, etc. Maybe, we have here Brent first, but maybe let's start with naphtha just to spin things around a little bit. Jorge, can you tell us what is your view on East-West on naphtha?
Yeah, first of all, I would like to talk about where are we now and
Yep.
where are we gonna start the year. So this year we have seen a high volatility in the naphtha market. In the East-West, we have seen a very strong uptrend during the last months. But after a small correction, looking at the seasonal levels, we are right in the average for January values. So I think we are going to start 2025 really close to the historical average, around plus $20 per metric ton. And then I have two different views. They are more or less in the same line, but one is for the short term because the market right now has a lot of details in Europe, and then another one is more a long-term view. So in the short term, I think the East West is going to remain strong, and there is potential to see even a little bit higher levels. And the main reason for that is that right now Europe is really, really weak. Not just in the paper, we have seen the prompt time spreads in contango for the last month, but mainly in the cash diffs. We are seeing negative values in Northwest Europe, low levels for the cash diffs in Med as well. So I see some upside potential for January and February translated into East West, because I think Europe is going to be stronger in the short term. And if Asia wants to keep the ARB open and the cash diffs raise in the West, they will need to increase a little bit the East West. And I think that is my view for January and February, mainly for Q1. And then we have more a medium-term vision, more fundamental or structural vision. That is, well, we can split between different regions. In Europe, the situation of the petrochemical industry is really weak. We have seen some companies announcing lower operation rates and even closing plants during this year, both in the north and in the west. And I think this trend is going to keep going. So probably we will see some more announcements like that for next year in Europe. In US, there will be new plants, but most of them will rely on ethane as feedstock, much more than naphtha. And in the East, we have a different picture. So the petrochemical industry is going to keep increasing, and they are going to need more supply. There are some mixed feelings in the East because we have an announcement in Malaysia of a plant that is going to close because of low margins. But I think the main trend is to keep demanding more naphtha from the West. We are not going to see double digits like in China during the last years, but the demand is going to be strong. So based on that, on the weak environment in Europe, on US relying more on ethane, and on the East building more and more facilities for the petrochemical industry, and on the levels that we are currently on the East West, my view is more bullish for the East West next year, especially in the short term. But I think we will see levels higher than the average for most of the year.
I mean, obviously, all of this depends on what freight does and all that. But the direction that you're pointing is that the Asian side will have a pull, and the European side will remain weak. Hence, a higher East-West or a sustained East-West going forward.
Yeah. That's my main view.
The absolute level of the East-West will obviously heavily depend on what freight does, and freight obviously will depend on what crude does, what refining margins do, and all of those things. But we'll discuss that later, no?
Yeah, and I don't expect a very big rally. At the beginning of this year, 2024, we saw levels higher than plus 30. I don't think we will reach them on Q1 next year, but we are in the average. I would expect something slightly higher than these current levels.
Since we're talking, let's remain in the light end section. Jorge, can you tell us about gasoline then?
Well, the same exercise done in naphtha, looking at the current seasonal levels, they are completely different. We have seen historical lows for many contracts during this year for East West, and we are seeing historical lows for January contract, and that's where we are gonna start the year. We have two parts. I've been looking at the fundamental part. One of the key things is new additions. In the West, we have two big ones, Dangote and Dos Bocas. Dangote is expected to be very linked to the East West because it would be bearish for the ARA exports. But I'm becoming a little bit skeptical about the Dangote impact. I was talking with Neil yesterday about it, and it was expected to be felt during this year. But we have seen uptick in exports from ARA to West Africa, especially during November. They are mainly linked to quality issues, but I don't think we will have a massive impact of Dangote during Q1. as we haven't seen it during the last quarters. So that would be the picture for the West. So no really big changes, apart of if Dangote change our export massively, but I'm not expecting that. On the East, we have new plants increasing their capacity in Middle East and in India. So the picture points to more supply in the East than in the West, I would say. And then one thing more linked to the short term is looking at the ARB's economic. If you look at our tour right now, and if you look at the ARBs pointing to the East, Europe is really competitive into the East. We have talked about this in many podcasts. We have seen this trend during this Q4, but ARA is the cheapest source of supply into many destinations in the East, especially in East Africa. So I think this is going to keep the East-West low, because higher East-West will be that ARA ARBs to the East are even more profitable, and ARA is already pricing itself into the East, so they don't need a higher East-West in the short term. So combining these two views, I think we are gonna keep seeing a low level of East-West in the gasoline market.
But what about China? Because obviously, as we discussed last time, East-West is two pricing centers. Now, when you talk about moving barrels from ARA to East Africa, it obviously impacts the ARA pricing center, but it doesn't really necessarily impact Singapore as a pricing center. It will over time, but it doesn't immediately. But China barrels, they do impact Singapore directly. So if we are going to see less exports, as we discussed last time, from China, that will mean less volumes arriving directly into Singapore. Isn't that a more bullish kind of scenario for Singapore directly as a pricing center? Put aside the whole supply and demand, because it is important, but it doesn't give you an idea of timing,
Yeah, exactly. China gasoline export is going to be key for the Singapore complex and it's going to be translated into the East-West. But the latest spot news from China was increasing the expected export for November. So, I mean, the feeling is that this year they are gonna be lower, but the latest thing they have done is raising the exports from what was expected for November.
I can chime in on that. So I'm pretty sure that's partly about front running the VAT
Exactly,
exchanges, right?
I was going to say, yeah. Mm-hmm. So, I mean, I'm skeptical about that. I'm obviously not trading. I don't spend much time looking at the market, but it just seems, I've been myself in situations where, on a supply and demand perspective, we see all these ARBs going into East Africa, into Middle East, into things like that, but it doesn't affect Singapore at all. Or it only does affect Singapore maybe 3 months later when you have a surplus of barrels in the Middle East, in East Africa, etc. And then you start seeing the repercussions as AG now then starts importing into Singapore. But until we don't see that happening, that is something that we need to take into account. If we do see a lower exports out of China, for me that is quite bullish Singapore relative to other markets, if you want.
Yeah. That could be one of the risks to my call on low East-West levels, and you're right that we have to see the confirmation of the arbitrage from Europe. It has been open to some Eastern places during the last month, but we have to see the confirmations on January arrivals.
Okay, moving on. Sorry, go ahead. Mm-hmm.
Sorry, I just want to make one point on China, and that's like a bit of a devil's advocate thing, and it was a point I was going to make later in the pod. But at this time of year, right, you get these forecasts from some of the Chinese agencies. So the CNPC one came out this week, and they're telling us that basically the oil demand peaked, or road fuels demand peaked already in China in last year, 2023, mm-hmm. and it's dropped again this year, about 1.5% in 2024. And they're basically saying by 2035, demand for gasoline and diesel will drop as much as 50%. And it's partly on EV penetration, it's partly on LNG trucks filling in for diesel trucks and all this kind of stuff. So what if you get basically the same amount of runs, but a 5% decline in internal gasoline demand? And basically they might just be forced to export. So it's just a sort of devil's advocate message that maybe China surprises everybody because we've been saying that doesn't look like they're going to export much next year, but maybe they're forced to export it.
I agree. I mean, it doesn't make too much sense to be at the same time claiming that you don't need, or the local consumption is going to be creeping lower every year, and at the same time not be reducing the export quotas. That something's going to give here. I'm just basing myself. My assumption is just based on the fact that the export quotas are lower, but do they change them? That's a different story. But based on the information I have right now, I'm just putting there a caveat to that argument of lower east-west continuously over the sustained period of time into next year. I have some doubts around that. Especially again, we have those bocas, and those impact directly pricing centers like Houston or ARA. Now, I agree, Dangote, we don't know yet who is going to be supplying WAF. Is it going to be Dangote? Is it going to be ARA? That's a quality game. It's a Naira game. There's so many different moving pieces there because the FX is also who's very important. Who's going to be storing that FX risk? Is it going to be Dangote? Can they do it? Or is it going to be an MPC directly, or the traders themselves?
Yeah.
That's a big question mark. But again, I get your point,
I
Jorge.
think
I'm just putting there a sort of like a caveat there. Mm-hmm.
No, good. Yeah. I agree with this.
Dangote has the potential to be quite a sort of funny trade next year, right? So it's got already a pretty checkered past in terms of operational sort of fitness. It's one giant CDU, it's one giant RFCC. Like that thing is probably going to break down quite a lot. If I have to make a forecast about it, I bet it breaks a lot. And and the same is true of Dos Bocas. It's supposed to be running, and then the last thing I heard, it all of a sudden wasn't running again. Mexican runs look pretty low, and we've been saying these things are going to start up for like 2 years, and it just never do.
I mean, for a trader, this is, I think that Dangote for a trader is going to be a very entertaining kind of game because obviously, putting aside the whole is it running or not running, but just the whole quality spread there, it's a very interesting one, and it allows for many trading opportunities. So something to monitor. Just conscious of time, guys. Let's move on. Diesel. Neil, you want to give us your point of view on diesel east-west?
Yeah, I'll do it very quickly and then we can do crude and move on. But yeah, I think it's largely the same game, right? So I can see a scenario where east-west is actually wider than we've seen for particularly the last few weeks. So I think just now east-west is kind of tight, largely because of the lack of Chinese barrels, right? And it's a substantial decline in sort of Chinese exports versus what we're used to at the moment. And then I'm thinking about there's capacity rationalization in Europe. There's like 200-300 KBD worth. There's the 265 KBD Lyondell Basel shutting down in Houston in January. So you've got like maybe 500 or something runs coming off in the West. I think Dangote and Dos Bocas look delayed. Let's not sort of count on lots more barrels coming out of those places over the next few months. And at the same time, you have more expansions in the Middle East. So you've got something like 200-300 KBD worth of expansions over the next 18 months in the Middle East ramping up. You've got Duqm, you've got Citra, Karbala. And I just think that makes for basically as 2025 progresses, you're talking about basically a wider east-west where this thing that we've seen over the last couple of weeks reverses and Europe needs to draw in a bit more barrels than has been seen over the end of this year.
Okay. And well, since you're at it, give us your point of view on crude. Brent, Dubai.
Okay, I'll take this one.
Oh, sorry.
Go for it, June.
Yeah, so I think you're seeing like around one plus MBD of non-OPEC supply growth, and it's mainly in the west of Suez. A bunch of refinery rationalizations are also coming in Europe and Asia. So Western balances are a bit longer. And some of these growth are also even North Sea barrels, i.e. the 220 KBD Johan Castberg coming out in the Barents Sea. On the other hand, you have OPEC keeping a very steady supply and basically tightening the Dubai contract. Sanctions risk, for example, on Iran will also go in the same direction. So it looks like EFS should narrow. Right now, we are looking at sub $1 per barrel on the EFS already, but it's really not that narrow if you recall that EFS did go negative before. So I think this scenario can be real, particularly if Iran gets shut off. Interestingly, though, geopolitical premiums typically manifest in Brent strength. So yeah, it remains to be seen how the EFS will work out, but our view is it will narrow further. And as with all East-West stories, freight has an influence. Freight could cool down substantially on not Red Sea normalizing, but there is also a spike. It could increase as well if more volumes are taken off the sanctioned crude market, i.e., China goes on less Iranian and more spot MEG.
No, I agree. I mean, we obviously we're not covering freight in this in the discussion that we're having on East West in general, because obviously freight will have a dramatic impact on all of the different East Wests that we can discuss. This is more of a supply and demand picture for both east of Suez and west of Suez, and how would that affect? No? But I'm just putting there a sort of a caveat with anything that we say is also subject to what happens with freight. But okay, very interesting. And one of the big topics this year has been obviously refining margins, and where everyone was extremely bearish, and then we had some surprises, like in the Gulf Coast and even in Europe, picking up when again the whole market was extremely bearish on that. Let's talk about what do we think are going to be the average refining margins next year. Are they going to be higher? Are they going to be lower? And why?
Well, I think we are seeing that the net capacity additions are actually slower in 2025. We have plenty of shutdowns happening in the US, the P66 LA refinery and the LyondellBasell Houston one, Europe as well. And you compare this against the average in 2022 and 2020 to 2024, and we have about 1 MBD demand growth according to EIA. Caveat, there's also the LPG element in the demand growth. So on paper, there is a net tightening of product balances, more so on the light ends market, affecting naphtha and LPG. Then also seeing whether, as we've discussed many times now, Dangote and those broadcasts, are they really going to run up to the capacity that they are premised for? And what if China doesn't return as this major swing supplier in the market? If from OPEC plus exports, how would that look like? I think if I'm with them, I would try to tighten up the product market as well as crude to generate more demand in the market. So from freight perspective, expectation is still on the depressed side. We've seen reports that the VLCC scrapping rates are low next year versus the amount of new build coming online. And with older vessel age, this may translate to further freight discounts. So the delivered cost of oil likely will remain low. So all this is pointing towards actually a stronger refining margin. And it could be a scenario where margins do end up higher, slightly higher than what we've seen in the Q3, Q4 average this year.
Anything to add there, Neil? Or
yeah, I don't think we're going to return to the sort of H1 levels or 2023 or 2022 levels. I think we're past that, unless who knows? Unless you take 1 million barrels a day of Russian gas oil off the market, for example, or a bunch of fuel oil. I mean, it's still a risk, right? I do think that the main thing is that you have another chunk of demand, and then you're just slowing down capacity additions. So from a sort of directional point of view, it doesn't look as bad as, let's say, the last couple of years. So yeah, I definitely agree.
So yeah, on the demand side, so let's unpack a bit more on the end user demand side. The base case of the agencies is between 1 and 1.5 million barrels a day. Is that the case? Where is that
Something like
coming
that, yeah.
from, and what can be the surprises here, the upsides and downsides?
Yeah, I think my general view is that it's sort of maybe the opposite view from a tightening refining market perspective. I think the upside risks are kind of weak at the moment, and the downside risks are probably stronger. So, a lot of stuff is still coming from growth expectations are still coming from kind of India, Brazil, Southeast Asia, some of which is going to be LPG. I mean, typically these things are loaded towards the light ends. So it's usually sort of LPG, naphtha, and a bit of jet. And interestingly, the same study that we talked about in China, they're expecting jet demand to basically rise by another 70-80% by 2035. So jet is the main sort of supportive factor for distillate. But I think the upsides are kind of limited. We've talked about China now. Are they going to be successful in stimulus efforts? Not sure yet, but it seems like they're in structural decline anyway. And then I just wanted to say about the downside risks. So it seems like the downside risks are fairly strong, right? So we've got the risk of tariffs, we've got the risk of macro shocks, OECD's anyway in basically structural decline. We've got petchem that's in overcapacity and needs to basically rationalize. Is that fair to say? Still. And we've also got just continued sort of EV penetration in basically all markets. I know that they've made a big thing about a slowdown in EV sales this year, but I think it's
Well, it's
basically
definitely
inexorable.
it's definitely been the case in both the US and Europe. I mean, or I wouldn't know, I wouldn't call it a slowdown, but it's not the EV taking over like it is in China is definitely not taking the place in Europe or in the US as it was expected. That, that's
No,
what I can say. Yeah.
not without major subsidies like in Norway. A place like
Right.
Norway is obviously very different. But, these models will get cheaper. It's just you got people like BYD basically flooding the markets now with all kinds of cheap models, and that's why basically European governments and US government is trying to put tariffs up, right? Because they're very concerned about their auto industries, particularly in Germany. So we'll see how that plays out. There's also new rules coming in, right? So I think automakers, I might be wrong on this, in Europe, I think they're being forced from January 1st to have 20% of their sales being EVs or hybrids. And so they're kind of now discounting EV prices and raising petrol prices for new cars, basically. So yeah, we'll see.
Look, I did the exercise and I went to see a dealer here, a Volvo dealer. Volvo is obviously saying to everyone that they're going to stop producing IC vehicles and it's all going to be EV and all that. And basically, the guy was telling me that they're not selling a single EV car anymore because they've basically maxed out. Again, it's just one dealer in one city in Europe. We cannot make an example out of it, but the message was, look, we've maxed out everyone that could buy an EV vehicle because they had a garage where they could plug it in and all those, people who had the economic buying power to buy an EV vehicle, they did. But that's it, and now everyone else that doesn't have a garage, that lives in a flat, that doesn't, cannot charge it easily and all those things. And a lot of people, they were actually telling me a lot of people that bought an EV, they're trying to sell it back and buy a gasoline car instead, or a hybrid if you want. And look, I think that's a reality. It is happening. It's a slower. The charging stations are not as available as they thought they would be, and we're getting to that situation where the government is pushing, but the consumption is not there because of it's just not convenient enough. In China, it's a bit more directive, and everything is being done top down, and the charging stations and everything is being organized in a top down kind of way. So when you have a sort of strategic direction, it's actually happening. Over here, because everyone is, the different parts of it, it's the production, it's the cars, it's the regulation, but then there's the charging. All of those are managed by different people. You're not getting the results that you would expect.
Yeah, but there's pressure on both sides, right? So European governments they've got to hit their targets for emissions, right? But they just don't want to do it with Chinese EVs. And
Well, that's
so
the other
how do
problem.
you
Yeah.
it's a square hole and round peg if you like. So we'll see how the sort of legislation goes next year.
So to sum it up, because I'm a bit confused here, what is your point of view then? Because we have little upside on the demand side, but on the production side or the refinery production, we have a slowdown in the sort of surplus. Or so what's your, let's summarize this into a view. What do you guys think?
My view is a potentially slightly higher margin than we've seen over the last 3, 4 months, but we're not going to get mega margins back. What do you guys think?
Yeah, I think margins look supportive, and there are many things that can disrupt the markets right now that will, at least on the product side, that could lead to blips of higher margin, unexpected higher margin. And also, obviously, throughout the year, there'll be bouts of very low margin as well. But on average, it looks a bit more supportive than this year.
Yeah, and I mean the trend is on the upside. So we have seen the margin. I was looking at the US margin yesterday, and it has been rising not a lot, but during the last weeks. And I think that's where we are gonna end the year. I don't see any crack that can rally a lot. We haven't been very bullish on any crack, particularly Q1. But yeah, I think they can keep the trend and we can see higher margins than the average of this year.
Well, let's see what happens to crude as well, because if the bull case that Neil was describing actually does occur, then obviously that will have an impact on margins in an environment where demand is not the driving force, as you're describing right now. So is it fair to say that we don't really have a very, very strong opinion about margins, and let's just be honest about it?
Yes.
Okay. You seem much more convinced about the bull case on flat price than you are on, or at least you have not convinced me to a massive extent on the refining margin side.
Yeah, that's reasonable. I think the sort of bull case on the crude side is predicated on supply, right, rather than demand. And I guess it's the same is kind of then true on the margin side of demand. If we don't think demand's going to be amazing, then yeah, automatically it's not great.
Okay, guys. This has been a pleasure. Thank you so much. It's interesting discussion, obviously much more longer term than what we usually do. And for other listeners, thank you so much for your support, for listening. Please don't hesitate to like and subscribe to our podcast. We're not yet looking for sponsors, but maybe we end up. So please do like and subscribe. And in the meantime, I wish you all a very happy Christmas and a fantastic new year, full of opportunities for all of you. Thank you so much. Take care. Bye-bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.